Hi guys, welcome to the Big Blind, betting in startup ecosystem. Today I have a dear friend of mine, a very close friend I should say, Ashish Khetan. No matter how much I give a brief about him, it is still less. So why don't I ask Ashish itself to, give a short brief on any of the previous background which he has done.
Sure. Thanks, Rohit, for inviting me, and good to be here. So I've had a very different background per se. So never thought of getting into this or whatever's happened in life has just happened as a matter of chance. So from my past, basically, I've come from a Marwari family, business family. They settled in Nepal. I ended up doing my schooling in a couple of boarding schools in India because Nepal did not have, that many good schools. So have been a boarding school product all throughout my life from first standard onwards. So left home very early, had a very disciplined life, more like an army regimen. Post that, did my master's, graduation and master's from Delhi University, passed out from FMS Delhi 2005. That time the startup ecosystem wasn't very vibrant. So took up a couple of corporate jobs, started off my career with General Electric, worked in India, Dubai, relocated to Singapore, then switched to banking, was with Morgan Stanley for 4 years. And then subprime mortgage crisis hit. So everything started collapsing left, right, and center. So I became an accidental entrepreneur in the agri and food space. Ended up setting up an agri commodity trading company in Singapore for 2 years. Then came back, had a couple of joint ventures on the food processing side. Went back to Nepal, did that. And then 2017 is when I relocated to India. And along with one of my partners, Mr. Sunil, started Indiggram Labs, which has today become one of the most prominent agri and food incubators, accelerators in the country, where the idea is to nurture handle startups in agri-food allied sectors, anything with an intersection of technology, hardware, software, consumer brands. So across B2B, B2C, hardware, software, deep tech, biotech, overall have seeded, funded 90 plus startups, all in this space, and all first checks, small checks, 25 to 50 lakhs. Most of the cases being the only investor in that round, and companies have ended up raising upwards of 5,000 crores in follow-on capital. And 3 years back, we also set up an agri and food fund called Benzaiten Ventures. It's a SEBI Cat 2 fund. So we are in fund 2, made already 7 investments from the first fund and given 4 term sheets from the second fund, undergoing due diligence. So always happy to support and work with founders, startups. That makes me feel young, energetic, trying to learn from them, trying to see how I can contribute better to the ecosystem in general. So yeah, that's been my journey. I relocated to Bangalore 2 years back. Earlier spent a sizable chunk in Gurgaon, before that in Singapore. So that's been my journey so far.
That's really something which would attract a lot of young entrepreneurs to know the journey itself, how it has been pivoted and scaled. For those who don't know, Ashish is more like a business guru for me, I would say. Learned a lot in terms of how to maintain relations, how relations can benefit in a larger scale or in a long term. And that is, I believe, something which every founder should know, that it's not just about selling more their product, it is more about maintaining the relation so that the ecosystem gives you back. So that's the one of the main thing I would say I have learned from Ashish.
No, so there is mutual learning from founders as well, learning from you as well, the energy, the vibe. The idea is to keep hustling, being innovative, right? So I think it's likewise mutual both ways. So you give some, you take some.
True. So out of the complete experience, what you carry into the startup ecosystem, today we just wanted to have some address being done on the investor's perspective, because founders believe what they are doing is something which is definitely going to work, but it doesn't align with an investor perspective. Can you just help us understand why is this gap between a founder's perspective of scaling business and investor's perspective of scaling business?
So see, venture capital or any form of equity raise, not all businesses are meant to be in that direction. There are, in fact, hardly 5% of the businesses which can take venture capital money or equity capital. So they say that venture capital is like jet fuel. The only way it can go is up. It can't go in this direction, right? So there are a lot. In the past, there have been a lot of good businesses. There's still a lot of good businesses which can grow, compound well, but venture capital might not be the right capital for them. You raise debt, you build a good dhanda business, you scale. Venture capital is, or equity capital is for those businesses which are looking to address a large problem, where network effects can apply, and the company can become sizable, which can take in that amount of capital, and also well suited to the fund. Mostly these are tech ventures, consumer brands, consumer internet, and lately it's a lot of AI, deep tech also, which can take in that amount of capital where there is some intellectual property, there is barriers to entry is high, founding team is very different, but that kind of looking to build a really large scale outcome. That's where it goes. But having said that, the ones who are not getting money and running businesses does not mean those are bad businesses. Those are good businesses, but might not be suitable for venture capital.
I believe there are some scenarios where a person who has not raised money and is doing good business is making more money than the person who has raised money. And
yeah. So we have so many examples. There's Zerodha, there is Mr. Shridhar Wimbu, right, and a lot of other people as well. So if you can do that, nothing like it. I mean, what venture capital or outside capital does it fastens your growth journey. What you plan to achieve in 10 years might happen in 5, 6. That is what it does, because competition also takes over, and then some point there becomes a point where money is important to hyperscale for inorganic growth and stuff like that. But otherwise, obviously, I mean, you even when I ask myself whether it's a good idea to take money, I'll always be in dilemma, because it's a double-edged sword. Money comes with a lot of ifs and buts, right, as well. So yeah, one has to make a decision whether one wants to go that way or one wants to run it bootstrapped, expand, taking debt and stuff like that.
one thing what I know pretty clear is you do personally, on a personal capacity, help founders. So what is your perspective on choosing which founder to choose?
So see, my sector is very non-glamorous, where obviously you need founders who've spent a reasonable amount of time in the space. So patience, perseverance, they're gritty. The business plans will pivot. Idea is not to surrender and be there. So most of them are non-flamboyant founders. Those kind of stuff, who will ride the tide, at least take a decade into consideration when they're building something, wanting to become an entrepreneur, not come with a timeline saying that let me try it for a year or two, nothing happens, I go back to where I came from. And agri and these kind of ventures, supply chain networks, business networks, all those things are important. Even if you're building a tech product, what do you do with a good product which you can't monetize? So monetization is important. For that, network effects need to take place. For network effects to take place, you need to be reasonably connected to the network, be it your vendors, suppliers, buyers and stuff like that. So yeah, so that's what we've seen. So I think that is my way of assessing whether the founder is mature enough to give that much time. That is important. And how serious is he about building? Or whether it's a short-term thing that nothing happened in his past and he's just finding a way to escape and just trying and thinking that entrepreneurship is an easy journey. Right? So, and then how adaptive is he? What is his willingness to learn, explore, those kind of things as well. Once that is there in place, then probably, some amount of time and effort can be put in place to, be with the founder and work with the founder closely.
Got it. So I personally know that you believe in a long run game rather than short games. And in this long run game, we do see a lot of VC firms expecting 10x multiple or 100x within a short duration of time. what is your opinion on that? I mean, is it good to have a short run boost, or is it sustainable one is better? Which what do
No,
you
so see, one can't blame the VCs where they are raising capital from the LPs. They have a certain obligation to give back the money at a certain rate of interest. Otherwise, how will they get money? So, idea is to invest in businesses, like I said, right? Jet fuel. Idea is to invest in hyper scalable, or at least businesses which can scale during the life of the fund. Fund life is usually 7 years, 8 years. Nowadays, we've started seeing funds at 10 plus 2, 12 plus 3 years, right? And so whenever they invest, idea is that it should mature during the life of the fund.
Okay.
Right, so that's the amount of time. I would not say 3 years, 5 years, but maybe 5 to 7 years post investment they'll start looking for exits, right? So which means that it has to scale to a reasonable level to get that desired outcome, and generally the power law applies, which means that out of 10, 12, 15 investments you make, probably 80% will fail. So it's my way or highway. There's nothing called midway, and probably one or two might return the entire fund. So the power law will always apply in generating returns. It will not be a linear curve; it will be a non-linear curve. So which means that obviously for the outcome to be big, the problem statement has to be big, and they need to scale to that size so that they can return the fund to a much larger extent, right? So I would not blame them. So I'm a VC myself. So if we've taken money from our LPs, we need to be obligated to give them a good return. So idea is to then fund such businesses which can scale at that speed. See, a 30 to 40% growth year on year is a good growth, but if the base is small, obviously the expectation of a hyper growth is expected, right? So
I think this expectation is something which has to be set to founders, because most of the founders are not aware the why even VCs look at certain growth. Now that I think this is gonna have
so
a lot of
growth, capital efficiency, you invest 2 rupees, outcome 10 rupees. So it should not be a functional of just continuously raising and just increasing revenues to that extent. So somewhere the network effects and those kind of effects should come in so that the business becomes more and more capital efficient, and and it can grow during a reasonable time. Having said that, obviously deep tech has now become the flavor of the season, where the gestation period is a bit longer. There is a lot of advanced manufacturing, semiconductors, defense tech, space tech, etc., etc. We don't know how it's going to play out. We'll have to wait and watch, but there's a lot of capital coming in there. So I think depending on the space sectors, a lot of templates are also changing. Like earlier, asset light models were considered good. Now manufacturing plays, startups are raising equity for manufacturing plays. Earlier it wasn't the norm. So I think there is somewhat of a convergence happening between a VC and a PE kind of a model. That is also what we are beginning to see now. So we'll have to see how that plays. So yeah, so consumer theme always remains sorted, because most of the exits which we see coming is all happening in consumer brands and stuff. So that is there. Otherwise, there's a lot of money going towards AI and deep tech, and within deep tech, pretty much across. Very less is left for the other sector spaces, unless there is some kind of a differentiation or some traction in the business. At least for now, we'll see how that comes. The flavor of the season keeps changing every year. Currently, that's the flavor of the season.
Well said, I would say. Considering your profile as a VC, as an angel investor, as a mentor, and as a very good friend, you might have definitely seen more than thousands of founders, and you have helped most of them. What do you see as a gap in a founder's journey, which he is something which he needs?
See, I think being a founder myself, I've realized that a founder's journey is a very lonely journey. And when you're starting off, things are a bit slow. There's hardly anyone to help you. Right. So I think you need good mentors, advisors during that time, not only in terms of helping them in business, but also I think mentally, emotionally, to keep them motivated to do what they are actually wanting to do and aspiring to do. Right. A lot of them are also in self-doubt whether what I'm doing is right, whether it'll work. So as an entrepreneur, we don't know whether we'll see light at the end of the tunnel, but that's what entrepreneurship is about, right? There's so much of uncertainty. So I think there needs to be someone to push them there. And when you are starting off in the beginning, very, very early, it's hardly in anyone's interest to support, because it's all a matter of productivity and the amount of time you put in, right? So when things are going good, there are people around you, right? When things are slow and unvalidated, not validated, then it's its own journey, lonely journey, and it takes a bit of time for things to happen. So I think that's the time it's important for them to be motivated, at the same time focused, that our time will come. It's not as fast as it sounds, but gradually we'll get there in due course. So ride the tide, I would say, and find the right set of advisors, mentors who can guide them at the right time. So what I've seen is what needs to be done is ever evolving. Everyone is learning, but what should not be done, one should have clarity on. What क्या नहीं करना है is
That
more
only comes
important.
with the right advisor with you.
Versus क्या करना है, क्या नहीं करना है. If you end up doing that, probably you spend 2 years, come back to where you've started.
Fair enough. And most of the founders are not even aware to understand who is the right mentor or advisor for them.
That is a bit tricky. Reason being is the ecosystem is evolving. We'll find all kinds of people, everyone learns through their journey. Experience brings in everything over a period of time. Whatever you learn from practical experience is the real experience. There can be mentors, advisors with 1 or 2 years of experience. There can be with 20, 30 years of experience. So idea is to make the founder should use his judgment to see who's the right fit and who can add value in the long term, and who genuinely feels that you should succeed.
And obvious founders do burn their hands in this process.
They burn their hands with mentors, with investors. I'm generally saying, so not to name anyone, but mentors, advisors, investors, anyone.
True.
Some of them are not very happy with their set of investors, right? So capital has come, but alignment is not there, right? So it's like also, finding a co-founder is also a gamble, right? We don't know which way it's going to go. So it's all about taking a chance, and then obviously few things working, few things not working. One matures with time. Judgment becomes better. Sixth sense becomes better. That's why people value experience more than anything, right? The ability to judge experience things becomes better over a period of time. Then also you tend to make mistakes, right? So
I think that is what VCs even see when they are evaluating a founder, or what is his experience before, how has he dealt, or did he even scale anything before?
Yeah, correct. So see, second time founders have a high probability of raising capital, and if they've done well in the past, obviously, then in the beginning, obviously pedigree of the founders in terms of the qualification and where have they been working in corporate also matters. Opportunity cost of time is there. When you have nothing and just the bet on the founder, that's what works. Third category of founders is who have to build a P&L and go with a P&L, saying that, okay, this is my story, but this is what I've done so far. And then you raise capital. But every founder in the first category, which is a second time founder, must have definitely struggled in his first venture and was a third category founder.
Fair enough.
Right? So it's a journey. So, let's say you become successful in this, your second venture will be a relatively easier, right? At least in terms of raising capital. Whether the business will eventually succeed or not, it's basically your grit and being there, right place, right time, all those things. But, and raising capital is not a function of startup being successful, by the way. We've seen plenty of examples of companies raising hundreds of millions of dollars and startup not going anywhere, right? So, but yes, fundraising becomes a lot easier.
Fair enough. And I also see that in the startup ecosystem right now, there have been multiple helping hands for a founder. I mean, acceleration and incubation is something which has already been there. Expertise who have, started doing mentorship and supporting and raising funds. That is also a piece which has been existing. But now, I think there have been a lot of other sources which either help a founder to raise fund, let's say like cohort or any kind of a thing which people are doing about, or you can also say marketplace for raising fund, which is another thing which is happening right now. Traditionally, they also call it crowdfunding. But when a desperate founder sees this kind of an opportunity, what is the risk he would be going through by choosing such kind of platforms?
So see, I would say time is everything when you're doing a startup. If you don't have any takers, you go by what you get. If the business needs capital, otherwise the best advice is get some maturity in the business and go at the right time so that you have some sort of a bargaining power. But a lot of businesses, tech businesses, product businesses, they need money to build products. Monetization happens later, which means the burn is right now. Founders are running out of money, so in desperation they go to investors, accept whatever terms they give them. It shows on their face of the founders, which the investor can see, so he's going to bargain hard. So it's all a function of demand and supply in whatever you do in life, right? So when the investor sees that the founder is desperate, he'll offer not so good terms, I would say. And when he goes in a position of strength, then he'll probably agree to whatever the founder says, right? So going by, crowdfunding is something which has been quite common in the US. I think just beginning here, far and few, but these platforms might end up help you raise maybe a couple of crores, but not a couple of $1 million. I haven't seen that so much. It is a good platform when you're not getting anything. And idea is basically your negotiation skills or the founder's negotiation skills to negotiate and see what terms you can get. See, the founder, from a valuation perspective, the founder will always value his business more. But idea is that the law of averages generally catches up. You raise at a very high valuation, it averages out in the next round. You raise at a low valuation, it increases and averages out in the next round. So one should not be really bothered about the valuation in the beginning. It should be that at the time of the IPO, how much stake do I hold? Right? And we've seen plenty of cases of valuations in billions and now resulting in nothing, right? So valuation is basically a function of future excitement of your business, which can happen, which need not happen. A lot of it is execution dependent, external environments, whatever scenario, right? Regulatory, etc., etc. So I think I would say that raising capital is important at the right time, but if you're not getting too many takers, then figure out a way to, whosoever is there, find a way to negotiate and get some capital. Momentum is always important in the startup.
This gives me another question. There has been a talk or a say in market that once you register, you start a private limited firm, you got to raise your first round within a duration of like max to max 4 years, else VCs will not look at you. What do you think?
A lot of it is, I mean, to each its own. Everyone has a right to make their judgment. Some of them might be having a thesis around it, but I don't see, this is my personal view. I would not like to comment on others, but I don't see that as a deterrent at all. I think the more time you spend, the more mature you become. Your learning curve is higher, better. There might not be momentum in the business. So see, VCs are chasing momentum.
True.
If you're growing at 30-40% year on year, going to a VC, you'll not see value. So initial expectation is 2 to 3x kind of year-on-year growth because the base is small. Once you cross 100 crores or something, then probably the expectation of 2 to 3x might not be there. 50% might be there or something like that. So, and it is logical that when you don't have capital, you might not be able to grow at 2 to 3x, right? So it becomes a chicken and an egg story. And as per startup definition, obviously 10 year, anything registered under 10 years is considered a startup. So as long as you qualify that, it's fine. I think all the VCs can look at you. Now the thing is how much you end up exciting them, what is the interesting problem you are solving, what is the flavor of the season, what is your traction, how good is the founding team, everything coming together will make it exciting for them. It will not be just one thing.
Got it. Just out of curiosity, even for the audience who is seeing this video, just a view of total sizable amount of funds which you have helped raise or been part of it in the journey, so that a founder knows how much investor can help with the complete ecosystem?
See, I would say facilitating or helping raise funds, everything goes to the founder because he's running a good business. You can't be selling garbage to an investor and he will invest, right? That's never going to happen. So obviously the credit goes to the founder. But yeah, some amount of it is because of the relationships which have been there. So I think in terms of our portfolio companies, upwards of $500 million have been raised. I would not say that I have helped facilitated everything, but it's a sizable chunk. I would not like to put a number to it. And the initial validation of the funding as the first institutional check is very important. Later on, it picks up. So it's important to cross that hurdle. That is where the bulk of the effort and the time goes. Once that is validated, then that compounding takes over.
Why does the founder always faces the challenge of raising his first check? I mean, not from the angel perspective, but from a VC institution.
See, if you look at the example, companies like Airbnb got rejected by 99% of the investors. When the concept is new, it's very difficult to envision what this can become, right? And venture investing is always investing in something new, something forward-looking, where there are no benchmarks in the past. Now, deep tech, there's no benchmark in the past, right? Whatever is being built for the future. So one can't envision how big can this become and how fast can that become, right? So it's just a bet you are taking based on your gut and whatever you've seen, or if you've seen some success in your portfolio, you'll have some view to contribute, or based on the policies which are happening in the country, or where are the trends going. So sometimes the sectors are so hot that there is capital flowing inadvertently, right? Some of the sectors are not very hot and happening right now, so there'll be lesser capital flowing. There, the founders need to go with traction. So that keeps changing. I think every couple of years, what's not so hot today might become hot tomorrow. That sector, and what's hot, obviously, capital will flow. A lot of it will, just evaporate. But that's how it is. So there's a lot of capital chasing fewer companies or similar kind of themes. That always happens like that only.
What are the red flags in a founder which an investor sees?
So I think, one should not just go with an idea to a founder. One should hustle a bit and figure out some POC, some basic product. One should not just go with the saying that I have this idea and I need money to execute this. Investor might think internally, what have you done so far? Otherwise, everyone will go with an idea and start raising capital, right?
True.
So something needs to be done. So, and also I think it's important to time the fundraising also. One should not go very early. One should go with the intention when there is some sort of confidence that now my funding should happen. I have all the checks and balances in place in terms of what they want to see. So it's like saying, if you're saying this is my order book, they would want to speak to some of your clients or customers. They would want to speak to some of your suppliers. They would want to do a demo of your product. At least those things should be there. At least for a first-time founder. Second-time founder, obviously, there can be exceptions here and there, successful ones. So obviously, that's a red flag if you just go with no idea whatsoever. And so I think that is, and also they would like to see whether you've thought through in terms of what you are doing. So which means that when you don't have enough to show, it's taking a bet on the founder. Pivots will keep happening. So betting on the right founder is very important. Have you identified the team? Have you identified 5 years, envision 5 years later what's going to look like 10 years later? So idea is to see how big is the founder thinking. Will it be a lala business or will it actually be a big business, right? So I think that's also one of the things. Rest, obviously, it's an individual kind of thing. Some of them might not be able to relate to founders. Some of them might go deeper, and so it's, you don't know who gets funded by who, right? So it's a very different skill set which everyone is coming from, and based on the kind of experience they've had in the past, their view is limited to that, right? So like for me, it might be easier to make an agri and food investment decision, but not so easy to make other decisions, sectors in other sectors, right? So So it's also a function of the amount of exposure the investor has had in whatever he's done in the past.
With over the decade of experience into investments, startup ecosystem, every founder does feel that, yeah, why is the founder, investor not responding me? Utna busy hai kya chal raha hai? This kind of thoughts definitely be there. Would want to understand your, a day with respect to investor as a, profile.
So see, there are for us, let's say we look at 50 applications at least on a monthly basis, which is about 600 per annum. This is all agri-food allied. How much can we fund at the end of the day? 10, 15, 20 companies, right? So which is what, 1:20 ratio, whatever that number is. Capital is limited. Same for other people. As a fund, they'll end up investing in 10, 12, 15 companies, right? So which means, and the deal flow will be very high. So some of them I've seen have a good habit of coming back saying, you are early, or this is the reason we're not investing. We want to build some more conviction, or we're not familiar with the space, or whatever the thing is. But obviously, since there are so many deals, there is always a lag in terms of getting back, or they will only get back when there is interest. Some of them will get back on everything saying that, okay, yes, this is the reason, no, this is the reason, right? So I think it's just because of the demand and supply. There's so much of so many founders, so many startups, but the capital is limited.
True. I mean, a number of startups do come to start every day, but
Yeah.
with respect to investors, the VC firms or the institutions don't multiply it in the same way.
Yeah, it doesn't multiply in that same proportion. Although lately we've seen a lot of VC funds, but still in proportion to the number of startups, far and few. VCs have also had their churn. A lot of them have come and gone, but and the new ones also coming up. Family offices also getting active. This unlisted asset class is getting more and more recognized. But still, in proportion to the number of startups coming in, it's very far and few.
A very few founders understand the concept of, the market being hit in a VC perspective, where, a certain agri as a sector, let's say example, there has been a great downfall in some of the largest organizations, and it does affect everyone else. But most of the founders won't understand this. Can you just drop some insights on why exactly this happens?
So, I mean, see, at least in our space, it's a cyclical business. Climatic factors, external environment, war situation, a lot of exports, imports will get hampered. Let's say, for example, a business relying on grapes, bulk of it is export business. Suddenly you see a season going down, the entire business going down, right? So I think I've seen a lot of founders diversifying the businesses to hedge that risk. There'll be some element of risk, but like big companies still make money no matter what the situation is. They might not be growing at that speed, but the business is well oiled, well diversified. They've been around for 30, 40, 50 years. They've seen all kinds of cycles. They've taken all provisions into consideration. For startups, it's like 3 years, 4 years, 5 years. One cycle comes and they go, right? So they need to see those long cycles. A lot of them have not been able to see that. And it's only happening. There was a COVID wave, a lot happened. Then obviously this war situation, a lot is happening. And so a lot of it is not in the founder's control, it's external factors. A lot of it is they are learning and creating controls around it. How do you do due diligence of the supply chain? How do you monitor controls at procurement level or something? How do you underwrite that risk?
True.
So all those things also, there are a lot of businesses happening on cash basis in rural India. How do you account for it and stuff like that? So I think that is where it is. I think the ones who've put in a reasonable amount of time, they're getting more mature about it. The relatively newer ones are getting hit by it because they haven't seen anything like that in the past. They learn with time, over a period of time.
But what about the investment deployment as a concept, where let's say in a particular sector, one of the largest organizations, they've been greatly funded and everything, but then it suddenly crashes, something happens. The related startups who are also in same sector, they also have the fear of not getting funded. Why is that?
See, the thing is, when you invest in a sector or in a category, people like to see success stories as well, right, over a period of time. So there needs to be, I'll tell you, there have been good success stories as well. So the consumer theme has played out well, the farm mechanization theme has played out well. Maybe the platform theme, people are still waiting to see what's going to be the end outcome. Margin pressure, how do they increase margins, how do they increase scale, how do they increase stickiness with customers. Some of the categories are playing out well, some of them are still evolving. A reduction in losses, improvement of margins, creating that product mix of your own brand portfolio, exports, value addition in supply chains, etc., etc. So I would not say some of them, it's also a function of some of them raising capital too fast and raising too much too fast. When the business needs maybe 5 or 10 million, suddenly you get 40, 50 million, you don't know what to do with that money. And bulk of it goes in experiments and you end up burning it, right? So you are burning and you are learning. So idea is you come, a lot of it should be already learned and prepared, and then you're asking the right amount of capital to grow. Everything the founder will not know, but assumption is that he should know a lot of it already, right? So that he uses his money wisely. A lot of it goes on experiments. When you get too much money, then you actually plan for. So like I said, the power law applies even in too much capital chasing very few deals. So the amount of money will not get distributed in the equal proportion to everyone. So 90% of them will not get it, 10% will get more than what they want. That's how it is. So I think that's what it is. What has played out in the past, where people have got exits, they're bullish on that category, more money is going to go there, and also where in whichever sector or categories there is more capital going to come. Let's say the RDI scheme government has announced, right? So a lot of money will go in deep tech. So one needs to see where the flow of capital is going. That's where the investor wants to put money. Otherwise, so let's say even if you think of yourself as an investor, you're looking at a startup. When you're evaluating to invest, you'll obviously think where the next round is going to come from.
True.
Right? Otherwise, your capital is going to run dry. So that fear every investor has. So right now, there is that, that growth capital layer is missing right now in India. Who does the $30 to $50 million check or $30 to $75 million check? Either there are private equity firms doing 100 million plus, or you just somehow reach 5 to 20, 25, 30 to 75 million is missing. Who does that?
True.
So the guy coming in that level will obviously think where the next round is going to come from, if the business needs capital there.
Considering that deep tech is a hot cake right now for any of the investor, in the present trend of ecosystem, consumer space is also something which is actively promising.
Consumer is evergreen. Consumer has always been evergreen, I think, and will continue to be, because
although it is clustered with a number of
but players. Now I think the evolution, a lot of insurgent brands, niche brands within that category are also coming in, where there might be some opportunity with quick commerce coming in, finding better ways of reaching the consumer through community building and, all sorts of things we've seen underneath, from 12 months where they are. So a lot of it can become viral. So idea is to reach consumers at the cheapest price possible. And a lot of, in that segment, a lot of differentiated plays are happening, something to do with kids, something to do with kitchen appliances, and, a lot of categories here and there. I'm beginning to see protein and supplement has become a big space within the food space, right? So position between health and wellness and food, and within health and wellness there's so much of nutraceuticals, and so a lot of differentiated categories are coming. How much will they scale would need to be seen, but I think now with the quick commerce coming in, it's fair to assume that 250-300 crores can be achieved.
Got it.
Whether they're going to cross the 1,000 crore threshold needs to be seen, far and few. But by the time a lot of them get acquired or, find takers in some form or the other.
There has also been a movement observed in the VC ecosystem where, let's say, agri-tech in edtech as a concept, it was booming for 4 to 5 years, and then the trend has shifted to some other sector.
Yeah.
And then 4 to 5 years in some other sector.
So like I said, the flavor of the season keeps changing.
Okay.
So it's also a function of that moment. See, having said that, companies are getting funded in those spaces. Physics wala got funded, a lot of other players got funded. Within the sector, the right models are getting funded. People are revisiting the models, the templates. Agri companies are getting funded, but it's not in that proportion. So more consumer themes.
I think before it was pretty crazy.
Early it was a bit crazy, left, right, and center. So I think every sector goes through it. Then there's a correction. Then people wait it out.
You just gotta wait for the new IPO to go on. So
we're waiting for some IPO to come, and then the wave changes. And maybe by the time some bit of this AI bubble will also settle in.
Got it.
So the money will start going into boring sectors again.
I mean that is more like, I would say, boring sectors, but at the same time dhande wale sectors.
Yeah. So I think like in the last 8-9 years, I've seen platform plays, then a lot of B2B commerce, B2B startups, then cross-border, then climate. Now climate is also settled down. Right now everything is deep tech, AI.
Yeah.
So we
never know when this will shift.
Yeah. So we'll have to see. I think investing is taking about a decade into consideration to see how it pans out, and if the founder is good, some outcome will happen, and you need to stay invested for reasonably long for some outcome to happen, because companies take the time to grow. 2-3 year horizon might not be a good enough horizon to invest.
Irrespective of
7 to 10 years,
has to
7 to 10 year kind of window one needs to take to investing to get some reasonably good compounding to happen if things work. With some of the companies, not everything will work, but for the ones which are working, I think that much of time one should go with while making up the mind to invest. So if you are in need of that money in the next 18 months, 24 months, don't ever think of putting in there, because it's an illiquid asset. Liquidity will not come as you plan. You can't just sell it overnight. You'll just have to wait for it whenever you get it.
What about the emerging trend in the VC or investor ecosystem? I mean, we do see a lot of new VC firms coming up with a different thesis which founders didn't even think of. So, is there any particular thesis which they follow, or is it good to to have an adaptive thesis? Because let's say climate or sustainable as a concept, most of the founders don't understand it. But it is very important with the VC perspective. Any thoughts on it?
So see, I think from a current trends perspective, depending on how large the fund is also, a lot of themes are built. Like, anyone getting into vertical quick commerce, that is a theme. But that theme does not apply to all the funds, because the larger funds will think of that because it needs a lot of money. A small fund might be reluctant to invest in something like that because he'll keep getting diluted. It needs a lot of money. Earlier, we've seen vertical quick commerce in different categories. Now we are beginning to see B2B quick commerce, fulfillment for them, right? So since there have been 2-3 breakout companies at the top, so that entire ecosystem is getting built around quick commerce. So quick commerce has become, be it kids, be it fashion, pharma, what a lot of them will fail. Not all categories will succeed in the vertical plays, but maybe some of them might. So the theme exists because maybe some of them might get acquired by the big boys sitting on top. So the theme is basically also a function of where the trends are going, how will they get exits. So at the time of investing, one also envisions what kind of a path this company is going to take, how big is it going to become, where do I get my exit from? Is it through acquisitions, or is it, the next round of investor looking to invest and giving me an exit? Who will find this valuable? Who will pick this? Right? So the quick commerce trend is more like that, right? There is a taker if there is value in terms of what you're building. So deep tech is obviously fairly new. Everyone is watching how it will plan out. Space tech has evolved. Obviously, 2-3 stellar companies coming in. Now everything around the supply chain around it, from components to reusable to this, that, the entire ecosystem is getting filled up. So I think those are the trends, at least for now. Later on, but I'm super bullish on agri in the long run. I think for a country of our size, depending so much on agriculture, there's a lot to do. Maybe the templates will change. Founders will become more mature. But I think a lot will happen in the next 10 years, 15 years.
Got it. So this clearly, identifies that a VC or an investor himself has to undergo a lot of thesis and constant
So
working.
VCs need to evolve the thesis. A lot of time it gets evolved midway. It gets evolved based on what the current market scenario is. And the templates also keep changing from asset light to this, the fund life. So like I said, it's somewhat a convergence now happening between VCs and Ps. VCs are beginning to invest from a PE style of investing now. A lot of them. So that convergence I've seen in the last few years only. Earlier it was like quite aggressive and all over.
But with the current movement, considering with the Big Blind itself, dealing with a number of founders and ecosystem partners, we clearly see that the gap for a founder, not just on starting the firm, but to properly vision on how to execute his objective is something which is a gap. I mean, the how to execute is something which no one has taught him unless and until he has done something before.
Correct. That is something the founder learns in the journey.
Yeah, and then a lot of people drop out in that journey itself. And VCs do expect that, let me see if he has done that or not. And obviously in this journey, he definitely needs right mentors, right supportive partners, and a number of things. But most of the founders believe that, why should I give equity to a mentor? Because he believes his firm is going to be a very big someday, which is very true, very good to be that way. But most of them won't understand the importance of the value add given by the supportive partners.
So that's again, some people might have had bad experiences with some of the mentors, advisors, and they're reluctant to give to the new ones. And one also needs to spend a good amount of time with their mentor advisor to figure out where this is going in the long term. Because even if there's some mentor advisor, it's not a 1 year, 2 year journey. It's again like a marriage, 5 year journey, 7 year journey, right?
True.
Till the time the startup becomes reasonably big to stand on its own, where you know that I've crossed the valley of death and I'm not failing. I'm there to stay. So it's all hit and trial to actually see, and having that mindset that everything I'll do on my own is not the mindset one should go after. It's not so easy as it sounds. And also single founders also find it a bit tricky. So
and they just keep idea to themselves thinking that someone will copy it.
I also feel that at least 2 or 3 co-founder to hone chahiye.
Yeah.
One single founder will have expertise in something. A lot of things he'll not know. And it's a business risk. What happens? What if something happens to a single founder? Right. So investors want everything covered. So that's also there. And then it comes with complementary skills. Work happens faster. See, building a 50 crore business and building a 1,000 crore business requires a different mindset. Whether you're able to handle a team of 20 versus able to handle a 200 member team requires leadership capabilities. A lot of it gets developed. Similarly, the scale of the business. The more scalable it becomes, the bigger it becomes, the operational challenges are there.
What about the perspective where, having 1,000 crore turnover with let's say with a PAT of 5%, and having 100 crore turnover with a PAT of 30%? What is your...
So it's basically two different things because it's the efficiency of the capital, return on capital employed kind of matrix.
What do VCs prefer in this both that they carry?
No, so it depends far and few. How efficiently one has been able to reach 1,000 crores in revenues will define. Equity will become a lot more valuable because maybe he must have used a lot of debt. And
which is good.
Which is good. If one has raised $5 million and reached a 1,000 crore revenue business, the others raised 50 million. So we're not comparing apples to apples. And the other business is a consumer internet business. This is a B2B business. Consumer internet business will burn a lot of money, but the long-term value is there. B2B businesses come and go.
Got it.
So what's the long-term moat one is building, right? So all those things are a function of, I would say. So one has to compare apples to see where that is going. So I think, B2B businesses are generally low on margins. So a 5% PAT is a very good outcome, I would say. But if it's a B2C business, that a lot of capital will get sucked up. customer acquisition cost and LTV, different metrics, so obviously they would need a far more larger capital pool, but the moat is there. Assume that it is there, and long-term value is there.
Got it. I think this was a pretty insightful conversation what we had. For me also, to be honest, every time I sit and speak with you, I learn something. Irrespective of what we are doing, I think first me, it's just more like I learn something. That's where my mindset is more. And I believe most of the founders who are seeing this would be quite inspired to understand how the investor ecosystem works rather than him judging by his own experiences. Saying that Big Blind is all about betting in startup ecosystem. If you had to bet on a startup, what are the three main principles you would see in it?
So again, I would say it's building comfort with the founder, spending as much time, because at the end of the day, he's the jockey.
True.
Right? Who's driving it. So the more time you spend, the more you get to know what he's capable of. That too also is like a 5% only success ratio, right? A lot of variables are there in the journey. So founder fit, market fit, founder product market fit. If those things are there, then any sector is fine, I would say. More than the sector and the flavor of the season, I would bet on the founder and take a 10-year view.
Got it.
And wait patiently.
I think that's a pretty good take, I would say, which every founder should have. So, well, I hope this was pretty insightful. And once again, the Big Blind, betting in startup ecosystem.